This is Mark to Market, a podcast of BT Correspondents.
Hello everybody, welcome to Mark to Market, a BT Correspondents podcast that aims to provide analysis and insight on market trends and corporate issues in Singapore. My name is benpaul, and I'm a senior correspondent at the Business Times. Every week, my colleagues and I delve into a business story that matters. We're in the month of April 2025, which means we're getting into the thick of the AGM season. All Singapore-listed companies are required to hold an annual general meeting, or AGM, within 4 months of the end of their financial year. So for the many companies with December 31 year ends, the deadline for their AGMs is the end of this month. One company that's likely to attract a great deal of attention when it holds its AGM is City Developments, or CDL. This company's AGM, which is scheduled for the 23rd of April, could provide a window for investors into the state of relations between its executive chairman, Kwek Ling Beng, his son, Sherman Kwek, who is chief executive of the group, and the various board members who sided with each of them during their recent power struggle. It will be particularly interesting to see the level of support the two new independent directors, Jennifer Duong Yang and Wong Su Yen, received from CDL shareholders when they put themselves up for election after the objections initially raised by Kwek Ling Beng and some of the board members about the manner in which they were appointed. It will also be interesting to see how Kwek Ling Beng and Sherman Kwek address questions about the corporate governance shortcomings at CDL that they both called out during their recent fight. And of course, the AGM will be an opportunity for shareholders of CDL to get some answers about how the group plans to get back on track and deliver shareholder value after the recent boardroom turmoil. Now, I'll talk more about CDL's coming AGM later in this podcast, but let me first recount the extraordinary few weeks the group has had in order to highlight a few salient points about family-controlled companies and corporate governance. On the 26th of February, the day the company reported its financial results for 2024, internal tensions within its board, which had been apparently simmering for some time, suddenly spilled into public view. The company cancelled the results presentation it had scheduled for that day and halted trading in its shares. CDL's executive chairman, Kwek Ling Beng, then issued a statement accusing his son, Sherman Kwek, of, in as many words, mounting a boardroom coup. Kwek Ling Beng said in his statement that the two new independent directors, namely Jennifer Duong Yang and Wong Su Yen, had been appointed to CDL's board on the 7th of February without going through the nominating committee. In fact, the chairman of the nominating committee was not even aware of the nominations, according to his statement. Furthermore, there was no vote on the appointment of the IDs at a board meeting held on the 7th of February. Later that night, however, a director's resolution in writing to appoint the two new IDs was circulated and approved. Now, following the appointment of the two new IDs through this unusual process, CDL reconstituted its board committees. Specifically, it merged its nominating committee and remuneration committee. Kwek Ling Beng said in his statement that as executive chairman, he's not allowed to sit on the new combined nominating and remuneration committee. This, he said, effectively prevents him from being involved in the nomination process of directors and key management personnel, and gives the majority bloc on CDL's expanded board unrestricted control over CDL's leadership and decision-making, and that these directors will be able to extend their influence deep into the management ranks of the group's subsidiaries. Kwek Ling Beng was so incensed by his son's apparent move to consolidate power by supporting the appointment of the two new directors through an irregular process that he tried to have him dismissed from his position as CEO. This was, however, blocked by the majority of CDL's expanded board. Kwek Ling Beng ended his statement on the 26th of February by appealing to CDL shareholders for support in maintaining corporate governance standards at the company. He said, "It's imperative that all boardroom decisions adhere to the principles of transparency, integrity, and due process. I urge all shareholders and stakeholders to stand with us in safeguarding CDL's future. Your support is crucial in restoring strong governance, maintaining investor confidence, and ensuring long-term value creation." Now, Sherman Kwek didn't dispute his father's version of how the two new IDs were appointed in his own statement a day later, on the 27th of February. But he said the board changes were not to oust his father. The way Sherman Kwek tells it, the cause of the dispute was Catherine Wu, an advisor to the board of CDL's hotel arm, Millennium and Copthorne Hotels, or MNC. Sherman Kwek said Catherine Wu had a long relationship with his father and had been interfering in matters well beyond her scope at the group. To address the issue, Sherman Kwek and some of CDL's directors had proposed a resolution to terminate her advisory agreement with the board of MNC and another to affirm that she has no authority to influence the directors, management, and staff of CDL and MNC. Sherman Kwek said both these resolutions were passed by a majority of the board on the 21st of February. He said, "We considered them to be necessary to protect the interests of the shareholders and relevant staff of the CDL group and to restore proper corporate governance and accountability." So essentially, Kwek Ling Beng and Sherman Kwek were both claiming to be acting in the name of good corporate governance. Kwek Ling Beng was emphasizing the importance of transparency and due process in the appointment of directors. Sherman Kwek was seeking to address some alleged interference in company affairs by Catherine Wu. In my view, the issue of corporate governance and what it really means to investors in a family-controlled company did not get a proper airing at the time. In the first place, as soon as Sherman Kwek brought up the matter of Catherine Wu, the media went berserk, digging up everything and anything it could about who she is, where she came from, how she met Kwek Ling Beng, how she became part of his life, and what role she played at CDL. And of course, there were pictures too, a good number of them of her in the company of Kwek Ling Beng. After about 5 days of this frenzied interest in her, Kwek Ling Beng announced her irrevocable resignation as an unpaid independent advisor to the board of MNC. And he tried to use this irrevocable resignation to refocus attention on how Sherman Kwek and his allies on the board had breached well-established corporate governance standards. He said, and I'm paraphrasing here, "Now that Catherine Wu has resigned, the CEO and his team of directors no longer have any continuing basis for their corporate governance allegations about CDL to justify their board coup." He went on to say, "It's high time that we restore investor confidence and ensure those breaches of corporate governance committed by the CEO and his team of directors, including breaches of the SGX listing rules and the Code of Corporate Governance, will never happen again." But even at that point, the market's focus was still on the conflict between Kwek Ling Beng and Sherman Kwek rather than on the larger issue of corporate governance. It was clear they were still in a fight. In fact, Kwek Ling Beng brought up some of Sherman Kwek's missteps that he had mentioned in his earlier announcement, which included the failed investment in China's Sincere Property Group, which resulted in an extraordinary loss of $1.9 billion for CDL in 2020, the poorly judged investment decisions in the UK property market, which led to financial setbacks that culminated in CDL's earnings taking a dive in the first half of 2023, and the fact that CDL's share price has persistently lagged behind its peers. It seemed at that point that in order for the conflict between Kwek Ling Beng and Sherman Kwek to be resolved, one of them would eventually have to step down. And the market was, quite understandably, more interested in how things would play out, instead of whether the spirit of good corporate governance had been followed. Then came another twist in the story. On the 12th of March, exactly 2 weeks after accusing Sherman Kwek of a coup, Kwek Ling Beng seemed to have a change of heart. He announced he would drop the legal action he had launched in relation to the appointment of the two new IDs. He said he will remain as CDL's executive chairman, Sherman Kwek will continue as CEO, all current directors, including Jennifer Duong Yang and Wong Soo-yen, will remain on CDL's board. He added that CDL's board would put aside their differences and focus on strengthening CDL's business. This seemed to indicate, in my view, that he had decided to let Sherman Kwek have his way. It probably isn't the end of the story, of course, certainly not from the point of view of minority investors. After all the things that have been said by Kwek Ling Beng and his son, it seems very unlikely to me that analysts and investors are going to take harmony within the Kwek family for granted going forward. Consequently, the market could become much more skeptical about the company's governance and its ability to deliver shareholder value. After all, when push comes to shove within the family, can there be any guarantee that the company will stick to basic corporate governance principles and act in the best interest of all shareholders? What can CDL do to address these concerns, and what can it do to make itself more attractive to minority investors? I'm going to talk about that next.
Money Hacks by the Business Times delivers useful financial tips every Monday. Subscribe to the playlists in Spotify, Apple Podcasts, or wherever you listen to podcasts. But if watching is your thing, we've got you covered. Subscribe to the Money Hacks playlist in the podcast tab of BT's YouTube channel and watch as Howie Lim gets the inside scoop on the best money hacks. Subscribe and watch today.
And now, back to Market, a podcast of BT correspondents.
When I first began working in the Malaysian market in the early 1990s, corporate governance wasn't something a lot of people talked about. There were simply good companies and bad companies. The good ones were controlled by people with reputations for managing businesses well and looking after the interests of their various stakeholders. The bad ones were not. In fact, it was only in 1992 that the landmark Cadbury report was published in the UK. Among the key recommendations of this report were some basic corporate governance ideas, such as that the posts of chairman and CEO should be kept separate, and that they should be non-executive directors of sufficient caliber and number to carry significant weight on a company's decisions. These ideas have since been codified in markets around the world. In Singapore, we have the Code of Corporate Governance, which came into effect in 2003. Among other things, it calls for the chairman and CEO to be separate persons to ensure an appropriate balance of power, accountability, and independent decision-making by the board. The code also calls for non-executive directors to make up the majority of the board, and for independent directors, or IDs, to make up the majority of the board where the chairman is not independent. And, yes, the code is also very clear about the manner in which directors are to be appointed. It states that the board should have a nominating committee to make recommendations on these appointments. It also states that the nominating committee should comprise at least 3 directors, the majority of whom, including the committee chairman, are independent. But here's the thing. The code is applicable to Singapore-listed companies on a comply or explain basis. In other words, companies can deviate from the provisions under the code, provided they explain how their practices are still consistent with the aim and philosophy of the relevant principles of the code. My point in all of this is that Kwek Ling Beng was certainly not wrong to flag CDL's non-compliance with the code when it appointed its latest 2 IDs. And all the members of CDL's board who had a hand in appointing those 2 IDs should certainly explain themselves. But Singapore's market regulators are not going to do anything about it. In the end, the authority to appoint a new director rests with the board, never mind whether the nominating committee recommended the appointment or not. As an investor, I would argue that a company's corporate governance standards ought to be viewed through the prism of shareholder returns. Many corporate governance advocates will probably not agree with me on this, and I would very much like to hear from them. But in my view, no investor buys a company's stock simply because the company complies with every element of the corporate governance code. Investors buy stocks for only one reason. They want to make money. And that could mean investing in a company that is operating in a new, fast-growing sector, but run by an individual who holds the post of chairman as well as CEO, and also happens to be the majority shareholder. That's not necessarily a bad thing. In fact, before investing in a stock, I always check if a company has a principal shareholder who effectively controls the board and company, and who can be trusted to act in my interests. In many instances, the reputation of that individual is the reason I would decide to buy the stock or not. And I would argue that many investors behave the same way. For instance, over the past few decades, owning shares in Berkshire Hathaway was essentially a bet on Warren Buffett as a savvy value investor. Similarly, investing in Facebook since its IPO in 2012 was really a bet on Mark Zuckerberg. And investing in Tesla has been a gamble on Elon Musk, for better or worse. Now, I'm not in any way trying to downplay the importance of having independent voices on a company's board, but the reality is most small-time minority investors do not have the expertise to judge the suitability of an ID candidate. In the end, the IDs are essentially recruited by a company's controlling shareholders and management, and regardless of how well qualified they may be, those IDs do not personally have any incentive to question a company's business strategies too aggressively. Minority investors tend to start worrying about corporate governance when they don't make money. In fact, I would argue that much of the noise about corporate governance in Singapore over the last decade has really been about the poor performance of the Singapore market. When stocks don't perform for an extended period of time, or when companies are taken private at a very low price, or if some corporate transaction goes south, investors naturally start looking for someone to blame, and they start asking if the company has the appropriate people, processes, and structures in place, or in other words, if the company has good governance. So, where does CDL fit into all of this? Well, first of all, it's clear whose company it is. the Kwek family owns nearly half of CDL's shares, and those shares seem to have been voted as a block at past AGMs. Kwek Ling-bing and Sherman Kwek clearly call the shots at the moment in the running of CDL, and as long as the conflict between them doesn't flare up again, that will probably remain the case. Now, that's not to say that CDL will never replace these two top executives, or that the group will always be run by a member of the Kwek family. In the first place, Kwek Ling-bing is not getting any younger, and CDL has had a non-family member as its CEO. Before Sherman Kwek was appointed, the post was held for more than 3 years by an outside professional named Grant Kelly. But the top leadership of CDL will probably ultimately be determined by the Kweks, even when there is a conflict among them, and minority investors simply have to accept that. Some investors will remember that Kwek Ling-pik, who is a cousin of Kwek Ling-bing and an uncle of Sherman Kwek, quit CDL's board in late 2020 due to disagreements over its investment in China's Sincere Property Group. Two other directors who had also expressed reservations about Sincere followed him out the door. CDL took remedial action to staunch the fallout from Sincere, but Kwek Ling-bing and Sherman Kwek both remained in their positions, and new board members were recruited to replace the ones who had departed. This doesn't mean that minority investors have no agency, or that there's no point having non-executive or independent directors on CDL's board. After everything that's happened, it seems likely to me that there is going to be more scrutiny by investors of the group's internal decision-making and the roles of various family members and their close associates, such as Catherine Wu. Kwek Ling-bing and Sherman Kwek are not the only two senior CDL executives who are part of the Kwek family. CDL's chief operating officer, Kwek Ike Sheng, is a nephew of Kwek Ling-bing, and Vincent Yeo, who heads the managers of CDL Hospitality Trust, is another of Kwek Ling-bing's nephews. Given their family ties, I think investors are going to want more detailed information about the reporting lines among these executives in order to have more assurance that business will continue as usual, even if there is some internal family conflict. This was, in fact, one of the questions the Securities Investors Association of Singapore, or SIAS, asked during the recent turmoil at CDL. SIAS also wanted to know how the performance of CDL's CEO and COO is assessed, which is understandable given the family links to each other as well as to the executive chairman. SIAS also asked what role Catherine Wu played while she was on the board of MNC from June 2022 to January 2024 and how she performed during that time. SIAS also asked about the basis of her subsequent appointment as an advisor to the board of MNC. Specifically, SIAS wanted to know if there had been a rigorous search and nomination process for that role, and what were the key deliverables and responsibilities. These sorts of pointed questions are probably going to be par for the course after the recent turmoil, and CDL's board, including its independent directors, should think hard about these issues and be prepared to explain how they're being managed. So, what will it take for CDL to get itself back into the good graces of investors? The way I see it, CDL should use its upcoming AGM on the 23rd of April to send a strong message to its shareholders about a couple of things. The first is that it is serious about delivering shareholder value. There is clearly a problem with the traditional property development business model in Singapore, given the negative externalities it creates for society. The profitability of traditional developers effectively turns on the public being burdened with increasingly expensive housing and potentially crushing mortgage debt. And as we've seen since the global financial crisis, the Singapore government has been willing to stamp out any sign of overexuberance in the property market with more and more cooling measures. CDL shares are currently trading at about $5 per share. That's a fraction of its net asset value as at December 31 of $10.17 per share, and its revalued NAV, including gains on its investment properties and hotels, of $19.86 per share. CDL needs to come up with a credible plan to unlock some of that value for its shareholders and garner a stronger market valuation for its shares, in my view. Now, to be clear, CDL has tried to unlock value before. For instance, it was targeting to monetize $1 billion of assets last year, but that plan did not excite investors, and in any case, CDL didn't succeed in meeting the target. So it needs to come up with a much more ambitious value unlocking strategy and execute its plans more aggressively. Another issue that CDL should address is the perception created over the past few weeks that the appointment of its two newest IDs was not done properly. As I said earlier, Kwek Bing was not wrong to flag CDL's non-compliance with the Code of Corporate Governance in this matter. Even if he now accepts that it's appropriate to have the new IDs on the board and that they may add value in some way, the fact remains that they were appointed without going through the nominating committee. The way I see it, the new IDs, as well as the members of CDL's board who supported their appointment, should fully explain at the coming AGM how this approach enhanced CDL's governance. The other directors of CDL should also explain their initial objections to the appointment of the two new IDs and why they have now changed their minds. Minority shareholders of CDL can then decide for themselves how to vote. At the AGM, the two recently appointed IDs are required to seek re-election if they intend to stay. Also, under CDL's constitution, 1/3 of the company's board members are required to retire each year and seek re-election. Of the current 9 directors, excluding the new IDs, 2 were last elected in 2022 and will certainly be among the 3 seeking re-election at the AGM. They are Colin Ong and Wong Ai. As it happens, these 2 board members were on opposite sides of the conflict. Colin Ong was aligned with Kwek Bing, while Wong Ai was on Sherman Kwek's side. In fact, Wong Ai was one of the directors who nominated the 2 new IDs. Now, if the Kwek family supports the election of all these directors, the manner in which CDL's minority shareholders vote probably won't affect the outcome. But the views of minority investors will be evident from the overall vote count, and that could be important. After all, no self-respecting director of a public listed company would want to remain in their position without the broad support of minority investors. That's it for this edition of Mark to Market. BT Correspondents will be back next week with wealth editor Genevieve Kwa, so please keep listening. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm benpaul. As always, thank you for listening and join us again next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.